Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shireen Bhan. Now, this week on the show, we bring you part 2 of our special series, The Unicorn Health Check, a show that delves deeper into what's working and what's not for India's billion-dollar startups. Today, we explore the real and the estimated market that India is targeting. Over $80 billion have been invested in 102 unicorns with a combined valuation of over $350 billion, many of which are valued at 10 times their global peers. However, most unicorns spend between ₹1.50 to 2 rupees to earn a single rupee of revenue, prioritizing growth over profit for now. But what is the big prize that India's billion-dollar startups are going after? Let me show you. Now, India has the world's second largest internet user base with about 780 million users today. That's twice as many as the US. And by 2030, it's estimated that India is expected to surpass China and have the most internet users globally with over 1 billion users. Now, can you imagine India's digital bazaar by 2030? Over 1 billion Indians spending an estimated average 7 hours on the internet every single day. That's 2 hours more than the Chinese, and that's the India consumer story that unicorns are supposedly going after. However, let's take a look at where the market stands as of today. The overall consumer market is about $1 trillion, serving a population of 1.4 billion people. Now, this is the business that most B2C unicorns consider. However, and here's a closer look at the numbers that are available with us, the market is much smaller and the obtainable market is even more so. The same applies to B2B unicorns going after 65 million MSMEs. The reality is less than 1 million of these small businesses are active or repeat customers. Now, while the opportunity is immense, the valuations for the most part seem far removed from reality. And that brings us to the reality of the actual users. As of 2022, 500 million Indians are not active transactors, meaning they do not engage in online transactions. Only about 300 to 325 million people actually transact online, but these users tend to be opportunistic with low loyalty. The more mature users who are frequent online shoppers and spend about half of their wallet online are only about 40 to 45 million. It is projected that this number could increase to 150 million by 2030. But even then, it would still be less than 20% of the real market. So let's pause here to ask the question, how deep and wide is India's digital bazaar? Let me show you what our unicorns are actually catering to, and let's start with Zomato. Of India's 40 to 45 million frequent internet users, just about 17 million make up Zomato's monthly active users. Let's switch to Nykaa, company that's targeting 180 to 190 million online shopper base. It gets regular orders from just about 24 million active buyers. This gives us a sense of the real market versus the opportunity. Now let's talk about Byju's. It has the largest group of school-going kids in the world as its target market, 350 million. So while it's impressively registered half of that population, guess how many are actually paying customers? Only 7.5 million pay any money at all to Byju's. For Cars24, which operates in India's fragmented used car market that sold 4.4 million cars, in FY22, Cars24 had less than 1% share. The scope of the market is also visible when we look at the Indian stock market. Now, in a nation of 140 crore people, just about 8 to 9 crore hold a demat account. And India's top broker, Zerodha, has a usership of 1 crore. The picture's not very different from the enterprise side either. Of the 65 million micro, small and medium businesses in India, off-businesses client base stands at about 0.7 million. Which brings me to the big question that we are asking. Are founders and investors overestimating growth prospects and the target market size? How long will it take for startup revenues to start justifying the valuations that they command? And finally, will the next set of startup IPOs get real? And joining me now to help answer these questions and more, Nithin Kamath, the founder and CEO of Zerodha, and Rahul Taneja, partner at Lightspeed India Partners. Nithin, Rahul, many thanks for joining us here on CNBC-TV18. Nithin, I want to start by asking you, before we talk about the prescription, let's get the diagnosis right. And I want to understand from your perspective, what do you see as the big problem, the big malaise that India's startup ecosystem is facing today?
Yeah, I think it's hard to generate revenue from from a large group of Indians. I think to be able to generate revenue, I can't see how you can really generate revenue from the top 5 crore Indians. It's very hard to figure, and I think people are struggling there. So like even in broking, I think I somehow feel that we've kind of hit a plateau. Because the new user growth has dropped, the existing users aren't really adding more as such. So I think the big challenge is that while India is a large country, we're still a poor country, and the real problem to solve in this country is to kind of get rich inclusively, get a lot more Indians to a position where they can actually spend money online. I mean, I think we're still some time away from that happening.
So, if I were to understand what you're saying, and I know that this is a point that you've been reiterating for a while, and it doesn't seem like you've changed your perspective on this, Nithin, you're basically saying that the monetizable opportunity has been grossly overestimated.
Yeah, many times over. So.
Many times over. That's as real as it gets. Rahul Taneja, let's talk about this. Yes, India is a large market. Yes, India is a growing market. Internet users are getting added on, month on month. But how many of those users who are being added on have paying capacity, have spending power? To Nithin Kamath's point, that there has been a gross overestimation, in his words, many times over, of the potential, the monetizing potential of this market. And hence, it's out of whack when we talk about estimations, valuations, and the kind of growth prospects that both the VC community as well as the unicorn ecosystem is expecting or anticipating.
Yeah, thanks, Shireen. Thanks for having me over. I mean, yeah, I couldn't agree more. I think, to give you an example, every time somebody talks about, beauty as a category, for example, everyone looks at Unilever and says, okay, this is the number of towns, the number of consumers they're serving. But people forget it took many decades over in order to create reach and the right product for these consumers, right? So I think there is some amount of overestimation. And beyond that, I think people think that, capital can solve for creation of suitable products or propositions that may attract these consumers, right? But that is not very obvious to start off with, right? So most definitely, yes, I think the amount of paying population we have, as Nithin said, is limited. And, the important point is people first need to start off from who their customer is going to be and is there value to be delivered to that customer. Everything else follows from that. And I think the smarter guys zero in on that very quickly, and that is where they prosper.
Rahul, the question of who your customer is, does your customer have paying capacity, and so on and so forth, I would imagine that these ought to have been questions that have been asked by VCs of the unicorns that they've invested in and answered suitably and appropriately by those startup founders as well. There seems to have been a disconnect. How do you explain that, Rahul? Was it because of an era of easy money where you didn't really have to worry about where the next check was coming from, or even the size of the checks that were coming your way? Did that just get the ecosystem to gloss over addressing some of these crucial existential issues?
Yeah, I think great question. I think the question is about what do you prioritize, right? First, do you prioritize understanding your customer and developing a proposition that is attractive to them, or do you prioritize scaling over first understanding whether what you have is working or not? And in an era of cheap capital, yeah, I mean, a lot of people, including the investment community, prioritize scale over first solving for that problem. And that really is at the heart of the problems that many of these companies face.
Yeah, that's just one of the problems. But Nithin, I want to come back to you and to pick up on what Rahul was talking about. And this takes me back to the conversation that I had with the World Bank president just 24 hours ago, lamenting about what this era of zero interest rates across the world has actually done and how that hasn't allowed for the creative destruction that otherwise we would have seen, how it's led to a plethora of zombie companies across the world. And now as we move from an environment of higher interest rates, perhaps for longer, what would it mean in the specific context, for instance, of the Indian startup ecosystem as well, Nithin?
No, I mean, I think this is, when I look back to the last 4 or 5 years, I mean, this is something that sticks out, as in we've ended up creating so many non-resilient businesses that can potentially be sitting ducks if this winter lasts for 2-3 years, and it's not good for the ecosystem, it's not good for the country, it's not good for anyone, right? As in, I mean, also see the other angle in this, right, is that people talk about tax rationalization, so one of the things is that today if you had to take money out of a company trying to profit through dividends versus through capital gains, the tax differential is so much. I mean, you can, capital gains short, is 20%. If you want to take money through dividend, you end up paying 60-70%. So what I'm saying is that, even the investors today, I get to sit on a few boards, right? I mean, I don't think investors today really look for profitability, right? I mean, they're looking at creating max valuations, right? Because max valuations, exiting through capital gains is really a very tax efficient way to be able to make money versus trying to take profits out, paying, whatever, 2.5 times more taxes. So it probably also, this whole cheap capital is also kind of, I think wired everyone to think of business as valuations and not in terms of, business in terms of, like profitability, right? So, and these winters will come, right? I mean, I don't know how this will last, but yeah, but there's a problem. There's a problem, if I think we got lucky as India that we raised a lot of money, in the last 1-2 years. So I think, a lot of these startups have a lot of runway. At least, they have runway till mid next year, I think. So I think the real trouble would be like if this winter doesn't end by then, we probably will have an issue in the ecosystem of sorts.
When you say that there will be an issue, I want you to explain to me, what that could potentially mean. And you're saying that many, because they raised ahead of time, do have a runway up until the middle of next year. But what could this issue potentially look like, Nithin Kamath? You're saying that there are many who could, in your words, be sitting ducks who may not last if we do see this funding winter continue. Quantify for me what this issue could potentially look like.
Yeah, no, see, the thing is, if you're not able to raise money and, you're running out of money, I mean, the issue is, you can't survive, that's really the issue, as in, and the thing is, it's very hard, if you haven't already built a business where a customer is paying for you, it's very hard to get a customer suddenly, if you stop all discounts, stop all freebies and suddenly expect that a customer will, somehow turn up and, pay for you for something he wasn't paying. That behavior change. We've seen it at Zerodha as well. Reducing costs is like everyone will love you for it, but to increase even even if you have to increase by 1 rupees, the fire you get is just incredible. So India is really hard when it comes to to the ability to be able to make money from the masses. So yeah, so I mean, it is the issue is that if the winter doesn't end fast, I mean, I think there will be a lot of companies which will be forced to merge with others or forced to shut down. So.
Yeah, Rahul, and that's an important point that I want you to come in on. One is on what companies can actually do as far as costs are concerned, and we're seeing that across the board here in India as well. Startups laying off people, shutting down businesses that are now non-core and so on and so forth. But on the other aspect of being able to raise revenue, be able to monetize customers, how hard is that going to be? I mean, we haven't even seen how the Twitters and the Metas of the world are going to be able to get customers to pay for the blue ticks and so on and so forth. But to get customers in India who are already pretty price and value conscious to start to pay for services that so far they didn't have to. I mean, how easy is this pivot going to be? And will everybody be able to make it?
I think of this like muscle building, right? Muscle building doesn't happen overnight. If as a founder, your muscle was built around the vocabulary of let's say GMV, then for you to start building your muscle around margins or a margin pool, and how much of that you can extract, logically speaking from your customer, that muscle building is, I think, at the core of this change, right? And it doesn't come easy. Cutting down on costs give you a slightly longer runway in order to build that muscle. But unless you're building that muscle, saving costs will only take you so long.
Rahul, let's talk about what now and what next. And Nithin, I want to talk to you about what could potentially be the answer out of this issue of the trouble that you talk about. One, of course, is to try and build a much more sustainable, resilient business, which means going back to the drawing board and examining your business model. The other is expectation setting. And I know that that is something that you believe in strongly as well. But what is the prescription to your mind to get out of this?
Yeah, I think, one of the things I've seen is, there is almost an incentive in the private space to oversell, right? Because the ones who sell well are the ones who are able to raise the most money, right? And then once you get into that whole overselling zone, once you set the expectation, because money, whatever it is, private investor or public market, right? I mean, money always comes with an obligation. So I think the first thing people should do is set, like you said, set the right expectation for the investor. You need, a VC to be on your cap table, for the right reasons. I mean, you don't want to be overselling to him just to be able to raise capital, because once you oversell, then you have to constantly keep doing whatever to kind of meet the expectations you've set. So I think one is that. Two is, I think there's a lot of bloat in the industry. People have hired mindlessly, and I think some of the bloat has to be cut, and like what Rahul was saying, if you reduce your costs, you at least get a much longer runway. I think right now, everyone should kind of plan for the worst case, which is assuming that the next 2-3 years are going to be hard. If you're not in the top 1 or 2 of whatever industry you are in, it's going to be hard for number 3 and below to raise money. And so I think the other thing to do is just to do whatever to ensure your runway is extended as long as possible, and also try figuring ways in which you can start monetizing users and stop all the freebies and etc. I mean, it's hard to transition when you already built a business in a certain way, but I think this is one of those times where it has to be done, because if it's not done, I don't know, it'll be very hard to survive through this.
Yeah, it's not a matter of choices, it is a matter of necessity. But Rahul, as companies try and make this transition, and to Nithin's point that, look at everything across the board, line item by line item, and cut the bloat. But outside of being able to cut costs, I mean, how do you grow in an environment where the ecosystem is so used to cashbacks, discounts, freebies? I mean, how do you stop the cash burn in the quest for customer acquisition, in the quest for growth?
Let me give you an example, right? If you have a 10,000 crore company that makes 1% margin versus you have a 1,000 crore company that makes, 20% margin, which kind of company would you want to be? Right? Historically, people would obviously optimize for, okay, I want to be large. I want to be a 10,000 crore company because, hey, money is free flowing. I can continue to do this forever. And, we seem to think this is such a big deal, but, if you look at all traditional companies, it's not like they've not worried about their cash flow in the past, right? I think people need to become a lot more responsible about how they treat their businesses, both on the cost side as well as the revenue side. That, I think, is number one. And B, I mean, yeah, it is difficult. Yes, it is painful. But you got to make the choice today that you want to be surviving and be one of the top 2 or 3, like Nithin said. If you're not there, you're not really going to be valuable.
Yeah, it will come back to the rule of 3, essentially. But Nithin, coming back to you, and I think this would be helpful for many entrepreneurs who are watching this program. Of course, you didn't have any obligation as far as what to deliver to VCs or investors because you didn't have any. You bootstrapped your way to being a profitable enterprise today. If I were to ask you today, what were the do's and the don'ts that you followed that will continue to be instructive in an environment like this, what would you list out?
Yeah, I mean, just be conscious about the cost of acquiring a customer, right? As in, until date, we haven't spent any money acquiring a customer, and it's a much harder way to build a business. There's no way to build it fast. It takes a lot of effort, because you have to.
How? Nithin, break this down. Break this down for everyone who's watching. In the episode last week as well, we said that on an average, at the higher end, people are losing 9 rupees to be able to get 1 rupee back. The average is between ₹1.50 to 5, which is what unicorns are spending. That's the kind of burn we are seeing to be able to acquire customers. How did you acquire customers without going down that road?
So the thing is, you can't build a business quickly, I think, right? As in, I started trading the markets in the late 90s, and, I think of Zerodha actually as like a 20-year plus journey. So, really, us hitting the scale and all of this success has been after 15 years of, of a lot of struggle. So, I think over the last 5 to 10 years, somehow, there's been this illusion that you can quickly build a business. Building business, there are so many interconnections. Like, it's growing a forest. You can grow a tree, but growing a forest takes time. So I think you need to have like patience. Then the second thing is, your product offering has to do the talking, right? I mean, if the product is very commoditized, if 5 people are selling the exact same thing, I don't even know if there's a point in running a business like that, because you at that point, if it's a commoditized product, it automatically becomes the deepest pocket wins kind of game, right? So I think it's about constantly trying to up the product. And because one of the things that I've seen with a lot of startups is they stop being like a startup very quickly, all right? I think the whole business here is that today's world is about the fast beating the slow and not beating the small. But startups very quickly become slow after raising money and building bloat. I think one of the reasons I think we've been whatever little success we've had is because even today we're probably as fast or faster than the even the youngest startups in our space. So. Yeah, I think these 2-3 things, and also I think people have forgotten that the world has changed. Today is a world of interconnections, right? As in through social media. So if you offer something which is differentiated and the user appreciates it, I don't know if you really have to spend as much money as you had to spend, like, say 10-15 years back. The people talk to each other about good products, So I think these three things.
Well, stop being or thinking like a startup. As soon as you start to raise money, you have to take on a different mindset, a different temperament. Rahul, what would you list as the to-do list at this point in time in a difficult and challenging environment?
First, I think number one, in addition to the cost that you add when you add employees in a company, you also add a large amount of noise and a large amount of bandwidth being consumed towards managing people. I think one of the benefits of being small teams is that significantly higher collaboration exists, and that is where the nimbleness comes from. So I think that is absolutely up there in terms of what we think should happen. And I think second is, a lot of people talk about this, but a lot of people don't do this, which is being obsessed with their customer and constantly innovating to deliver to what they want or they need, right? And I think it is in that I think it's important that role models like Zerodha, spill the beans a lot more on that or share their experiences, right? I think that is what people learn from.
Nithin Kamath and Rahul Taneja, many thanks for joining us here on the Unicorn Health Check, for giving us your take on what the problem is, diagnosing the problem, but more importantly, also helping us understand what the way ahead could potentially look like and what startups need to focus on to get themselves out of this current challenge. Thanks very much for your time. Appreciate you joining us here on Young Turks. With that, it is time for us to wrap up this edition of Young Turks, the Unicorn Health Check. We'll be back with a lot more. Don't go anywhere. We're back in a minute.